All right, so we published our first blog, and I already have to make an edit because we wrote it at 2:55 and the market sold off. So how do I edit it? So, but this is our blog we started. Where's the edit button?
Oh, I think it's that little pencil at the bottom.
The top. So we got it. You know, that's one last thing I forgot to do is check the market. So essentially what I have to do is right here, both hit all-time highs today. Both are at or near all-time highs. All right. Because the S&P was an all-time high until the last 5 minutes and we shut it down. So that's part of the editing issue we got to do. But this is our first time. I think we already have one like, you know, that's kind of cool. We'll see. We had a lot of authors, but that's fine. Some of them in this room. But we're trying to get people. Wow, look at that. 17 recent views. That's incredible. My previous one had 4 views. So to get, you know, so you can at the top of your head just start talking about markets, and you're not gonna, as a college student, you're gonna be like, oh yeah, you kind of did this. Once you get into the profession, it's just like automatically you know exactly what to say because you're thinking it all day long. So how do you emulate the professional job as a student? So you start sounding more like a professional and not like a student, and that's just, it's time. You just got to immerse yourself in it every day. Find some way. There's like a million things you could do. Some students are so overwhelmed they do nothing. The goal isn't to do everything. The goal is to find your niche and read that every week, listen to that every week, find those things. I listen to The Economist every single week. That's my thing. I love The Economist. They go around the entire world. It's really interesting. Some people read the Wall Street every week. I'm not a big Wall Street fan, but if you want to read the Wall Street Journal, that would give you some insight. That's an everything kind of everyday kind of thing. But find something so you're immersed every week. So, all right, let's continue on with the execution side of the investment strategy. So what kind of investments could you make? So last week we talked about mutual funds. Mutual funds used to be the big thing. They've kind of become less important the last few years. The one thing we did a lot of at USA is commingled accounts or separate accounts. A commingled account is a lot like a mutual fund, except for it's big investors. They're not traded on the stock market. You can't go invest in a commingled fund, but it does have a daily price that they strike, just like a mutual fund, but they just don't share it with anybody except for the people that are invested in the funds. So Fidelity might have a mutual fund, but they might also have a commingled fund where they have 10 really large clients investing billions of dollars. Usually a commingled account, you're gonna have to have at least $50 million to be able to do one. You may get better pricing. You're protected from kind of retail investors moving in and out, messing things up. So it's large investors. I remember Barclays, back before BlackRock purchased them. Barclays came and met with us. I don't know why they did. It was kind of a waste of time. It was an index fund, but we had $500 million with them. And I said, hey, we must be one of your bigger clients. Says, no, they should have said, yes, you're really important, but they didn't. They were so proud of how large they were. Said, no, you're puny to us. I was like, thanks. I really appreciate that. So $500 million was like nothing to them because they're, you know, these are massive funds. A separate account is a commingled account where you only have one customer. So a separate account is you go to Fidelity, you go to BlackRock, and say, here's $500 million. We want you to invest it for us, but only for us. Don't put any other money in there. That's a separate account. So you better be really large to do that. I've seen some people do separate accounts for like $50 million for a large high wealth individual, but that's usually you got to have a lot of money to do a separate account. So the question is, why would you want a separate account instead of a commingled account? It really depends on the asset class. With large cap stocks, it probably doesn't matter. You just want to be in a good fund that's well diversified. For some of the more specialized ones, a separate account might make some sense. But these are large investors. Exchange traded funds, which is what everybody's doing today. So you look at the growth in mutual funds, it's down. The growth in exchange traded funds is up. They've crossed. So these are essentially mutual funds that are traded like stocks. They have tickers just like the stock market. Remember, on the mutual fund, you can only buy and sell at the end of the day. With exchange traded funds, you can trade them like stocks all day long. So they're really, really cool things. So you get intraday trade. Supposedly you can control your tax gains and losses. When I first heard that, I didn't really believe it, but I've seen some articles that convinced me there is some advantages to that. I tend to do exchange traded funds instead of mutual funds, except for on the bond side. I still do bond mutual funds, but on stock side, it's almost exclusively exchange traded funds. They used to be just index funds. So the S&P 500, small cap, just index funds where you're buying passively, but now there are all kinds of stuff. And I may show you some here, some of the more exotic ones. They've gotten pretty crazy here, but probably the most common approach today. The nice thing about exchange traded funds, if you want to buy one share, you can buy one share. Mutual funds, that may require you to invest $2,000, $3,000. Exchange traded fund, if you want to put $50 into one and that's its price, you can do that. You may not make much sense to do that, but you can. So you can have much smaller dollar amounts to do that. So interesting. And then 401k plan, which is what most of y'all are going to do, that's essentially a commingled account. Sometimes they are specific mutual funds. Those are the worst kind, but a lot of times they're commingled accounts. So I can't imagine anyone in this room will not have a 401k plan. Any of y'all have one already? Y'all already started? Are you vested yet? Are you waiting to vest? Is it what, 5 years to vest? So how long does it take for you to vest on the money you put in? 0, right? So what are you waiting to vest on? The money that your company matches. And that could take 5 years, or it might be a stepped where you're 20%, you over time. So this is essentially a mutual fund set up by your employer that you can invest in. You get to do it with before tax dollars, which is huge. But what does that mean when you take it out? It's 100% taxable. Not just the gains, but everything you put in there is taxable. And when do you have to take it out? Usually at age 70. They keep changing those rules, so we'll see. So you put that in there and it goes tax-free for that entire time. You only tax at the very, very end. So it's tax-free going in, tax-free while you're investing, and then you don't get taxed until you take it out, but then it's 100% taxable in the end. A Roth 401k, which you can do, you have to buy after-tax dollars. It's tax-free while it sits there, and then it's tax-free forever. So which is better? Most people say Roth is better. A lot of firms, I think USAA was going to start a Roth 401k. So you can do it as a 401k, which means you get to use before tax dollars. So the money you put in there is not taxed today. It's only taxed at the end. Or you can use after tax dollars to a Roth, and then you're never taxed at the end. You have to decide which is the better one to use. But often your employer is going to match your contributions up to 3%, 6%, whatever. So you really should max out on what your employer is giving you. At USAA, it was so bizarre. USAA pays this massive bonus once a year, and a lot of employees shut off their 401k contribution for the bonus. It's like, why would you do that? You're throwing away, just throwing away money. The company USAA matches like 8%. So you could put 8% of your salary in, they'll match another 8%. You're getting 6% invested, which is about what you need to invest to be ready for retirement, but you only need to put 8% of that in. If you cut it off at your bonus, you're just throwing away 8% of your bonus in good money. So you should do that, but you got to watch out. This is an evil industry. If they can figure out how to rip you off, they will. And one of the ways to rip you off on 401k plans is that they do bundled plans, which I hate. So what is a bundled plan? And how do you know if you have one? So USAA tried to bundle twice. I fought both times. I was like, I'm falling on my sword on this. Unfortunately, someone else in the room spoke up before I had to, and so I didn't have to follow my sword. But this is a big battle with me and the Human Resources Department. They wanted to bundle USAA's 401k plan. What that means is USAA was paying $500,000 for record keeping. That's the firm like State Street or JP Morgan that's managing all these accounts for you. keeping track of which employees has which money and all of that. Well, USA said, we don't want to pay $500,000 for record keeping. So, hey, JP Morgan, Fidelity, would you do this for free? He said, yeah, we'll do this for free. Just let us make sure your employees only buy our accounts. And we get to overcharge your employees for our accounts. And so Fidelity says, hey, we'll give up $500,000 in record keeping, but we'll make $1 million off your employees. So who wins in that scenario? The employer. Who loses in that scenario? The employee. Who else wins in that scenario? The record keeper. It's a complete sham. They try to argue at USA, well, our employees get more choices. It's like, but they don't need more choices. They got 13 choices. It's already confusing enough. We had some mutual funds we had actually in the plan that charged like 0.4%. They were going to give them that exact same plan, the same mutual fund outside the plan for 80 basis points, charging twice as much. And they're in a 401k plan. The way you battle this with your employer is federal law says your employer can only make decisions that are in the best interest of the plan participants. How is bundling the best interest of the plan participants? It's absolutely not. It's a ripoff. So some small employers have no choice but to bundle because they're just too small to set up their own custodial and record keeper, so they're kind of stuck with it. But still, just watch out for bundling. It was funny, a guy came from Dial. I don't know if Dial still exists, but a soap company. And he came in, he was just like, you guys at USA, you're so stupid. You don't bundle your plan. I said, okay, well, look at it again. That was the second time. And he was shocked that he left a company that was ripping off his employees. He had never known, he didn't know the math. And so he was kind of embarrassed at the end, but it's like, yeah, we'll look at it again. But I don't think it's in the best interest of the employees. So be careful with bundling. It's just a major scam. All right, so you should know the indices. An index fund is going to essentially match the indice. I can give you some examples of this. So if we do like Vanguard, I'll try this again. I should get a ticker. So let's do, I don't know what this one is. We'll see. Let's do Vanguard Institutional, but do S&P 500. It's not going to let me do it. Large. No, it's not going to let me do it. Market index. Yeah, I don't know what index this is again. We can try it against, we can compare it to the, it's not going to let me do it. Yeah, this might be an S&P 500, but if that were an S&P 500, you see how closely it's going to track. It's going to be really, really, really close. This may not be because it's not tracking as close as I would have thought. I wish I could find a Vanguard S&P 500. See, the problem with ETFs is that's all that comes up now. I don't want the mutual fund, but I'll bring in the ETF. I guess that's good enough. And here it is against the S&P 500. Let me do it again. Versus the S&P 500. I don't know how many years that is. But can you tell which one's which? Can't even see it, can you? They're right on top of each other.
How did you put on, do the comparison where you have?
You just click on comparison here.
Oh, gotcha.
So you almost can't tell difference. Now, it charges a fee. So why is it underperforming because of the fee? Well, what is the fee? What do you think the fee is on this index fund? What is that? 1 basis point. Why don't you see the 1 basis point? Well, because they do securities lending, which means they probably make 1 or 2 basis points on securities lending. We'll talk a little bit about securities lending later. So they probably give you exactly the S&P 500. Even after fees, they add back a little bit with securities lending. So look at the turnover. Is that high or low? 2%. That's really, really low. And what is that? A few names changed in the S&P 500. They gotta flip them out. So, and what kind of fund? It says it's large cap growth, but it's the S&P 500. It should be core, but for some reason they say it's growth. Again, the S&P is getting growthier for some reason. We did a Vanguard value fund. That's not going to do well against the S&P 500, but it's a value fund. But if we had it against the value index, it would have done really, really well. So it's underperforming because it's the value fund and not the growth fund. And you can see how much value's underperformed. But again, the expense ratio is going to be just ridiculously low. This one's a little higher, 4 bips, but still just really, really cheap funds. So what are the major indices? So the S&P 500 is the most popular one. That's one of the things we debated with our blog. We kept saying S&P 500, and we're trying to keep it to one page. We finally just took all the indice names out and just assumed people would know we meant the S&P 500. It's a market cap weighted. What that means is if Apple's 6% of the market, you're going to have 6% in Apple. And that reduces trade. And that's why that turnover is so low. All right. If you're doing market cap, if Apple goes up, your weight to Apple goes up. So everything's fine. You don't have to do anything. The Dow Jones is one of the most quoted, but no one uses the Dow Jones in business. It's a bizarre index. It's price weighted, which we don't even know what that means. I mean, it's essentially what it should mean. If a stock trades for $500 and another trades for $50, this one will have 10 times more. But the problem is they took these 30 stocks, and as I did stock splits, they kept adjusting the price. So today it's all over the place. It's a mess. I don't know who's keeping track of it, who's in charge of it. Absolute mess. Plus they put new names in, and I don't know how, when they bring a new name in, how they figure out its weight. Bizarre index. Small cap, the most popular one there is Russell, the Russell 2000, but Standard & Poor's does have a small cap as well. Either would work. Russell 2000 is 2,000 of the smallest stocks in the United States. Mid cap, Russell has a mid cap, but S&P has a mid cap. S&P's small cap is the S&P 600. So you have the S&P 500, the S&P 400, and the S&P 600. So S&P has small cap, but just Russell, Frank Russell, he made small cap popular, and so the Russell 2000 has just been the most popular one out there. But those are all popular on developed markets. MSCI, EFA. I can never remember what EFA. Europe, Asia. Well, that can't be right. Europe, Australia, Far East. I don't know. It's strange, but it doesn't include Canada. So if you want Canada, which is the developed market, you can't buy EFA because EFA doesn't include Canada, but you can buy EFA plus Canada. That's an index that's out there. Emerging markets, you notice MSCI, Morgan Stanley, no longer Morgan Stanley, but MSCI, they're really big on international indices. That's their thing. S&P has international indices, but MSCI is much more recognized on the international indices, and they have a whole lot more history than Standard & Poor's, so they're just trusted more. So those are the big ones. On the bond side, it used to be Lehman Aggregates. Why don't we call it Lehman Aggregates anymore? You want something called Lehman Aggregates after Lehman went under in 2008. So Barclays purchased Lehman, or still there. I saw the CEO of Barclays. He was bragging about how cheap they bought Lehman's bond indices for. Lehman was the most impressive, most sophisticated bond shop in the world. And everybody's worried when Lehman went under, they're going to lose all these high quality employees. So Barclays stepped in real quickly, bought them out cheap. They didn't bail out Lehman, but they bought their bond side of their business, and they called it the Barclays Ag. The other big bond index is the Merrill Lynch aggregate. Merrill Lynch doesn't exist anymore either. They got bought out by Bank of America. So in 2008, both of the major bond indices got got trampled by that market. But Barclays aggregate, Merrill Lynch aggregate, those are the most common ones. They're heavily skewed toward treasuries and mortgage-backed securities. The last time I looked, it was like 70% treasuries and mortgage backs. So this is a very unique index. Most people will buy a corporate bond indices. So they want corporate bonds, not necessarily treasuries. So you have to be careful. These indices are heavily weighted toward government bonds. The original indices that were developed in the 60s were equal weighted. So if you had 500 stocks, you put 1/500th in each one. But the problem with that is every single day you're out of balance. As one stock goes up, one goes down, you got to rebalance. And so how often do you rebalance? And it got really expensive. If you rebalance every single day, you're going to be trading, you're going to kill yourself in the trades. So it's a tough weighting to maintain. So equal weight actually performs or has historically performed extremely well, but that's mainly because value stocks have performed very well until recently. So equal weighted, there's articles that equal weighted is the better approach. For a small investor, you could probably do it, but you'd have to decide when are you going to rebalance, because you can't rebalance every single day. You can't be doing, I got to trade one stock here and 0.5 stocks here, and just not going to be able to do it. So most people say rebalance once a quarter. Every 3 months rebalance, that could make some sense, but equal weight works pretty well, but it is a value trade. You think about it, growth stocks are expensive, value stocks are cheap. If you equal weight, you're intentionally overweighting value stocks, underweighting growth stocks. So you're intentionally a value investor. So it's somewhat of a bias in your trading. And then the new thing is fundamental weighted. And this is something you could certainly go out and Google. Robert Arnott, Asness, fundamental weights. Big debate. These two have been fighting this for some time. That's 2017. But Asness, he's the guy over AQR, the hedge fund, really good writer and speaker. Arnott, he took over Bill Gross at PIMCO. He is Mr. Fundamental Weighting. That's his thing. So what is fundamental weighting? Really interesting. What you do with fundamental weighting, you don't weight equally. You don't use market cap. You don't use stock price. You use some accounting measure like revenue or net income or net worth. You use some accounting measure to weight your stocks. So it's a very interesting approach. Pretty relatively new. And so what's the debate that Arnott and Asness are having? Asness says this is just value investing again. Because when you weight it based on revenue and not on market cap, you're going to essentially be buying more value stocks and less growth stocks. It's another value investing. That's what Asness says. Robert Arnott says, yes, that's true, but value investing is the way you should go anyways. So, this debate they're having, you should listen to their debates. They are both just impressive people. Asness has won many awards for his articles that are really good. And one thing you'll love about his articles is he goes out of his way for really provocative titles. Some of them I can't repeat in class. So he loves really provocative titles. He likes to get your attention. He's a very interesting guy. He's interviewed quite a bit, so you can find him on YouTube. Arnott is not as podcast as Asness is. I don't know if you'll find Arnott much on YouTube. He does speak at conferences quite a bit, but he's a quieter, shyer guy. He does write incredibly good articles. Anybody was my risk class, they actually did an article by Arnott in my risk class because he's a really good writer. So you can do more research there. The guy at USA that used to work with me, he started a fundamental weighted portfolio at USA. You may have heard it referred to as Smart Alpha. Have y'all heard that before? Smart Alpha? Some people call it Smart Beta, so that's a big debate. So what do we mean by alpha and beta? So beta is the market itself. Large cap stocks, small cap stocks, that's beta. Alpha is how much you beat the market by. So if the market's up 10%, you're up 11%, your alpha is 1%. You beat the market up 1%. What Asmus is saying about fundamental weighting is it's really not alpha, it's really beta. You're buying value stocks, which is a beta play. So that's where that comes into. So if you just do smart alpha, I bet R0 will come up again. Smart beta. So he calls it smart alpha, smart beta. Depends on your belief. There's some interesting article right there. So some good articles would come up. Smart beta versus smart alpha. Just what is the debate? It's really a philosophical debate on exactly what you're doing, fundamental weighted. I did put the methodologies for S&P and MSCI out there. We looked at the MSCI for emerging versus developed markets. I'd recommend you read the Standard & Poor's one. It's much shorter, gives you some really good ideas how to decide what's a small cap, what's a large cap, what's a growth, what's a value, what's the emerging markets, what's developed markets. They give you a really good insight. MSCI does as well, but theirs is like 100 pages. So it's just a lot of reading. It would be interesting reading. You get a lot out of it, but it's pretty intense. This is very statistical kind of stuff. So I remember when growth versus value first came out, it was so simple. They just took the Russell 1000, they took the PE price to book ratios and just ranked them from the highest price to book to the lowest price to book. They went to the midway point and cut it in half. The low price to books were value stocks, the high price to book and growth stocks. That's simple of an analysis. I mean, it seems too simple, but that's all they did. So I think they've gotten a little more sophisticated today. What are the other indices? Oh, there's so many of them. I can never remember. China's SZ something. You know, Japan's, Europe, England. You got all these different indices, but definitely know these. These are the most popular ones that you'd be thinking of. And usually, you can say the U.S. market's up 2% when the S&P 500 is up 2%. You can make the U.S. stock market the S&P 500, even though small cap and those others are not in there. The S&P 500 is probably 85 to 90% of the U.S. stock market, because these are, especially today with NVIDIA and Apple, all these trillion-dollar companies, it's really dominated by large caps. So they're probably 90% of U.S. stock market anyways. So they're gonna pretty much give you the U.S. stock market. Are there other indices that you are aware of? I mean, seeing Pakistan and Sri Lanka at the top, I don't know what their tickers are, but those are really thin markets. And some of these markets, I mean, what's the biggest stock in Sri Lanka? I have no earthly idea. There's some markets that may only be maybe dominated by 2 or 3 stocks that could be 90% of their entire indice. And so you're not really buying Sri Lanka, you're buying a particular stock in Sri Lanka. So you got to be really careful if you get down into the smaller countries. All right, so let's talk active versus passive. So active, you're a stock picker. You're trying to beat the market. What's Google's new name? Yeah, what does alphabet sound like? It sounds like a bunch of letters, but what is it? Break it down. What is it called? Alphabet. What does that mean? Buy alphabet to have an alphabet. Is that why they named it alphabet? Some people think so. So you're betting on alphabet to beat the market, and that's going to be your alpha. So maybe that's what they meant. I don't know. I'd love to hear that discussion. So if the index is up 4.2%, you need to make 4.2% or more after fees. So if your fees are 1%, you're going to have to make 5.2% just the tie. That's why those fees are so critically important. So what are you looking for? You want managers with good processes that can consistently outperform, but performance is incredibly unreliable. Historical performance is not a good predictor of future performance. And it's really hard to tell the difference between skill and luck. Just because a manager's done well in the past, there's really no indication how they're going to do going forward. There are a few. So who's the most famous investor of all? James Simons, probably. So what is James Simon doing? He's not going to tell you. He's a billionaire. He's a mathematician. That's just scary a little bit. He heads Renaissance Technology. Have you ever heard that firm? So this is a firm that just makes money, makes money, makes money. Like no one really knows what they're doing. He keeps it really quiet because why should he tell you his secrets? That's why those TV commercials, pay us money and we'll tell you how to beat the market. It's like if they knew how to beat the market, they wouldn't be telling you how to do it. They'd just go do it themselves. They can make more money in the stock market than they can selling software, which tells you the software doesn't really work, but selling the software works. So that's how they make their money. But yeah, you might read up on James Simons. I doubt you can find a YouTube of him because I don't think he talks to anybody. James Simons interview, well, there he is, an hour long. I don't know what he's saying. Number file. So that'd be interesting. I'm almost going to go watch that right now. But what is he going to tell you? Could you watch that and go away and immediately become a great investor?
They're not number follow general diversity now. So that's interesting math.
Oh, that's the name of the site.
Yeah, that's what they do.
Do you think he's talking about investing on that or something else?
Talking about some of the math that he does.
Yeah, it may be interesting. I mean, we'd love to know what he's doing, but he has no incentive to tell us, obviously. So, so you're trying to find someone who can consistently. So James Simons is probably the most famous in that line. Warren Buffett has his great years and he has his horrible years. There's been so many headlines. Warren Buffett has lost his touch. He's on the way out. And then 3 years later, Warren Buffett has refound his groove. He's doing great again. Why is that? Because he's a value investor. When value's doing great, he does great. When value's not doing so great, he's kind of mediocre. Is he a great investor or a lucky investor? We really don't know. You assume he's a great investor, but what we know is investors who are lucky early in their career become great investors because they get a lot of money and people, so there's definitely some luck involved. So you got to focus on the process. Is it repeatable? Is it logical? Those kind of things. And then you just hope for the best and you just don't watch performance every day. Or you give up on all of this and just buy the market and don't try to beat the market. Just buy the market. You'll win about 85, 90% of the time if you do this. So up here, only about 10, 15% of managers actually beat the market. So you're already starting off with a pretty low probability of finding that 10 to 15%. You might say, well, let me just hire them. But the ones that outperformed in the past won't be the ones in the future. So you're actually looking for someone who's underperformed in the past that's going to start doing well in the future. It's a tough, tough assignment. No one's really good at this. If you believe markets are efficient, the efficient market hypothesis, and we'll talk about that, that might be an argument just to buy the market because it's so hard to beat the market. So what is the EMH? Did y'all have this in a previous class? That sound familiar, Gene Fama? So a book I would highly recommend by Andrew Lowe. It's called Adaptive Markets Hypothesis. Really good book. Dr. Lowe, great guy. I've met him a couple of times. He's an MIT professor. You can watch his entire corporate finance class online for free. I think MIT has it available. You'd be surprised. It's a MIT graduates class, but they don't cover anything more than we cover here at UTSA undergraduate. So it's a pretty simple class, but you get to hear him talking. Really brilliant man. He is an absolutely brilliant man. But in this market, he's talking about this whole concept of how random are markets, how predictable are they, and he actually kills some of the efficient market hypothesis in his book. He talks in his book about a time he was presenting his findings that markets aren't as efficient as Eugene Fama said, and the guy who introduced him came up afterwards and says, well, obviously you have some math errors in your analysis. You need to correct those because obviously the markets are efficient. And then the guy went back and reran the math that Andrew Lowe had done, and he found out Dr. Lowe was correct. So he had to apologize to him for bad mouthing him after his presentation. But if you want to question what your college professors are not allowed to tell you, which is that there is some debate about the efficient market hypothesis. Read his book. He is a professor and he has the right, to criticize these major theories, but he's an interesting professor. He says markets aren't efficient, they're adaptive. They evolve based on whatever happens in the market. So people who went through 2008 changed them. They became different type of investors, and then new people came in after them. Markets adapt, they respond differently. But if you believe in efficient market hypothesis, that markets are really efficient, what do you mean by efficiency? So there's information efficiency and fundamental efficiency. Information efficiency, which I think is absolutely true, is that markets react extremely fast to new information. So how long do you have when NVIDIA reports its earnings before the stock market moves? Less than a second, isn't it? So my first job as security analyst, I was going to go home and no one was leaving. And I was usually one of the last ones out. I was like, what am I missing? Where are people? So I asked the stupid question, why aren't y'all going home? And the guy's like, you idiot. IBM used to be an important stock. IBM reports today. Y'all know IBM used to be the biggest tech stock there was. It used to be bigger than all the others combined. Now they're like a little bitty consulting firm. But at that time, they were the tech market. So everybody's like, we're not going home until IBM reports. And so I just sat at my desk pretending to do something because I wasn't following IBM. But I knew exactly when IBM reported because the whole place went crazy. Everybody's running back to their desk, updating their models. I mean, it's an immediate. I do think markets are like crazy too efficient now because especially now with AI, we got computers competing on nanoseconds. Who can get the information first and react the fastest and do a trade. So I don't think you have any chance here, even if you're sitting at your desk staring at the screen all day long and trying to do trades. The second you see it and start reacting, and it's already 2 seconds too late. Everybody else has already reacted. So what about the second one, fundamental efficiency? That securities are always correctly priced at all times. What that means is if there's errors, they don't go in one direction. All the errors too high are offset by the errors too low, and the average is the best price there is. Is it possible stocks are overpriced or underpriced anytime in a fundamental way? And that's the hardest one to test. So there would not be any market bubbles. We wouldn't have uncorrelated errors. This week in Investment Society, I'm talking about an economist article, which is asking, is the U.S. stock market overpriced? Looking at, the Cape line and seeing where it is. That's essentially an argument that stocks are too expensive right now. They're overpriced. That would be a challenge to the efficient market hypothesis. That shouldn't happen. So how do you test these things? And so this guy, Eugene Fama, he's still around. He's still kicking. He's the big proponent of efficient market hypothesis. I mentioned Asness, Cliff Asness. Eugene Fama was his PhD advisor. And Cliff Asness wanted to test momentum, which is an anti-efficient market hypothesis theory. So he goes into Fama to say, hey, kind of sheepishly, I want to test this theory, which contradicts the efficient market hypothesis. His PhD advisor created the efficient market hypothesis, and he was like, he's not going to let you do this. But Fama said, yeah, go do it. If you find something, that's great. But Fama's one that tested this, and he had 3 tests. You should have seen these tests. You should know these tests if you're a finance major. His first test was the weak form test. It's like if the only information you have is historical stock prices, can you beat the market with that? That's called technical analysis. Does that beat the markets? That's what all those commercials are about. Buy our trading software. We'll teach you how to buy stocks. Does that work? What's the most famous technical analysis? Have y'all heard of Dow theory? So you could do Dow theory. That's been around for a long time. It's talking about trends. You got major trends, intermediate trends, and noise. And how do you know you're on a major trend? How do you know when a major trend is changing? That's the Dow theory. Dow never wrote his theory down, Charles Dow, but people came after him and wrote his theory down. So we have it In fact, a lot of the software packages you see sold on TV, a lot of them are just using Dow theory and not a whole lot more. You can find Dalquist's book. If I can spell her name correctly. I don't think it's Bunt Cakes, but I'm never really sure how to spell her name. There it is. Is that Dalquist? No. Well, if I could spell her name, I would show you her book. Maybe it has a U in it or something. I don't know. There she is. How close was it? Oh, I left the H out. Okay. All right. She was a professor at UTSA. She wrote this book with this other person. She even taught a technical analysis class here at UTSA before she went off to another school. This is a fairly good book, at least the first few chapters. I couldn't make it through the whole thing because it's just, I'm not a technical analysis person. It's not my thing. But she does a great job in this book setting up why technical analysis might make sense, which contradicts the efficient market hypothesis. But she actually argues a very strong argument that technical analysis assumes markets are efficient. Information's been in the market, everything's lined up. Fundamental analysis is perfect. People are out there running their models. She says the only thing we don't know is the supply and demand. And she says what technical analysis is telling you is the imbalance between supply and demand when everybody's reacting to all that data. You might have too many buyers, too many sellers, and technical analysis tells you that. So what kind of technical analysis could you do? Well, FinViz is great. I love FinViz. The Bloomberg machines have really good technical analysis. You just have to word tech. But if you look at FinViz and click on a stock, it won't let me do it. So you look at Apple. What are all these little lines here? Yeah, moving averages, corridors, that's all technical analysis. And they do it for you. I don't know how they do this. I'm sure the computer does it. I don't know how the computer knows to connect these two lines though. So they're saying that's a low and the next low is going to hit that and the next low is going to hit that. So if it hits a low right here, you want to buy it because it's going to jump off of that. Does that really work? And then what if it breaks below? It looks like it's broken down, hasn't it?
Yeah.
It's come back down. So does that work or not? Who knows? That's kind of your theory. The moving average, you see a big gap there. What do stocks usually do? They usually like to fill the gap, and sure enough, it did. Yeah, but usually when you're looking at it, it says, yeah, it works really, really well. It's when you're looking at the current spot and you got to make a decision going forward. That's when it gets really tough. But looking historically, you say, wow, it works really, really great. So what Fama's asking is, if you had all this price data, could you beat the market trading method off of that? And he said no. Now, one of his tests that was pretty impressive is he got a lot of actual stock charts, and then he created a bunch of random ones. And he gave them to technical analysts, and the technical analysts couldn't tell the difference. So if there's really information there, you should be able to tell the real charts from the made up ones, and they couldn't tell the difference. So that's a little bit of a challenge. But guess what? Andrew Lowe sorry. He has a book. I wanted to be on Amazon, so why did that switch? I don't know why this is. Where is it going? Come on, Bill Gates, you can really do this better. So here's his adaptive markets, but he wrote another book on technical analysis. This is a good book as well. The difference between Dalquist and your Lowe, Dalquist gives you the theory real quickly, and then she goes through all the different types of technical analysis, chapter after chapter. The frustrating thing with her book is, here's the theory, here's how it works. Oh, by the way, it hasn't worked in the last 10 years. Here's the theory, here's how it works. By the way, it hasn't been working recently. Yeah, chapter after chapter of these wonderful ideas that no longer work. Andrew Lowe doesn't do that. He entirely gives you the theory for technical analysis. Why could you make an argument that you should do technical analysis? And you got a pretty big name here saying there's an argument for technical analysis. If you want to be a technical analyst trader, I would recommend you read his book so you have a fundamental basis for why you believe it works. Because college academia says it doesn't work, kicks it out because of Eugene Fama. So, got to do some reading. But that's his first test. Does technical analysis work? And Fama said, no, it doesn't work. Andrew Lowe is saying, wait a minute, I think it does work. And this is the reason why it works. And then Dalquist says, I think it works because it gives you insights on supply, demand, imbalances. At least you have an argument for why it might work. The second thing Fama tested was the semi-strong test. He asked if you had public information that includes historical prices, but also earnings reports, anything else you can get on the company. If you had that information, could you beat markets? And that's a hard thing to test, but his test said, no, that doesn't give you an advantage. Because you have the same information, and that's probably even more true today than he did this in the 70s. Probably more true today because we react to information so fast with the digital age. And now we have computers that are reacting. But he said, you can't do that. Is James Simons doing technical analysis? Is he doing fundamental analysis? I don't know because he won't tell us. But it's very mathematical and quantitative, whatever he's doing. Cliff Asness says momentum works. Momentum is very simple. Stocks that are up tend to keep going up. Stocks that are down tend to keep going down. That's pretty simple. Asness says that works. It's one of the simplest things. You want to know what stock to buy today, see what stock is higher today than it was 52 weeks ago and buy that stock. That seems too simple, but that's momentum. That would be more of a technical analysis. Fundamental analysis is you're looking at everything you can get that's public information. And then the strong test is if you had all information, public and non-public, could you beat markets? And that one's really hard to test. Because what can you say about trading on non-public information? It's illegal. Now, technically, it's only illegal if it's material. If it's not material information, you can trade on it. But if it's material information, you can't trade on it. One of my students last semester said there were some case studies where a guy did trade on non-public information, but he wasn't found guilty. But I think in that case, the judge agreed that it was illegal, but that he was being picked on. It wasn't that material. He was like, it just wasn't that big of a deal. Martha Stewart got in trouble for this, but I don't think she was in trouble for non-public information. I think she was in trouble for perjury more than anything else. But she spent some time in jail. But non-public information. So if you're on the plane and the Valero CFO is next to you talking on the phone, and he or she says, "Man, when this hits the news tomorrow, then our stock price is going to soar. Can you run home and buy Valero stock?"
Yeah.
You can, but you're going to go to jail when they catch you. All right, so I wouldn't do it, especially if you're in the profession. If you're a CFA, the first phone call you make when you go home is not to your broker. Whom do you call first?
The lawyer.
You call your lawyer and say, "I just heard the Valero CFO say this." What's your lawyer going to do? He or she's going to call the Valero CFO and say, "You need to release this information now because someone heard it on the plane." And you're not going to trade. You're not going to even touch. You're not going to even go close to trading it. How are they going to find out that you did that? Well, David's never bought Valero stock, and yesterday he bought 1 million shares. Oh, he was sitting next to the CFO of Valero on that plane, or his uncle was sitting next. The SEC is going to look for any major trades, and they'll see David did a major trade, and they go, "Okay, is there any connection between him and non-public information?" So they'll find some way to figure you out, and then you spend time in jail if they catch you. Supposedly, if it's immaterial, you can take 1 million pieces of immaterial information to together a material, and that's legal. But then it's between you and the court to decide if it was material or immaterial. So, and the best thing to do is just not trade. Well, that's it's a subjective thing. Immaterial would be something that is not expected to move stock prices because it's just not that important. So I don't know if I can give you an example of one, but Yeah, I mean, it should be something that just no one would care about because this is not important. So Valero announced they're going to delay their holiday party by 2 days. Who cares? You start getting all information together, you start discovering, wow, they're struggling. They're going to start doing cutbacks. You find 100 different things they're doing. Each one of them, not that material, but when you put them all together, wow, they're struggling. They're going to be doing cutbacks. That would be a combination of immaterial that all together is material.
When you purchase like a lot of shares, like let's say you heard something, but you have someone else purchase it for you.
No, they'll find you. Yeah, you can't use it. Like you could probably get away with it, but if it's your uncle, if someone makes an unusually large trade, the SEC is gonna look into that if the stock price moved a bunch. Let's like Facebook up 20%. Let's say I've never put $1 million in a stock before, and the day before that, I bought $10 million of call options on Facebook. You think the SEC is gonna be calling me and checking into why I did that maybe I had some insight? I mean, I would think so. That would be an unusual trade. Now, what if I spread that out among 20 of my best friends? They're still going to be checking.
So you're saying that, just an average person, not necessarily someone working in this industry, they put that picture together on their own, they're in trouble?
Well, if it's immaterial information, it's okay. If it's public information, they're okay.
But I know you said it's like.
But if it's non-public and it's material and they get it.
I'm saying you're taking this immaterial information and you just put this picture together.
Yeah, that's fine if it's immaterial, but you got to make sure if it's non-public but immaterial, you got to make sure it's really immaterial. That's up for the jury to decide.
Okay.
So you're still at risk because they may say, no, that was material, that was immaterial. And you can ask your lawyer, and your lawyer may not be an expert on that either. So it's tough.
Is the difference between material and immaterial is whether or not you're technically guessing? Like you're making a conclusion, but what do you mean?
I don't know if I've seen an actual definition, so you probably have to.
Okay, so
you could probably Google and see.
Hear them say, "Oh, tomorrow we're going to have this big jump in stock price."
Yeah, that's obviously material. Yeah.
But if you figure out on your own without hearing them say that, oh, they're probably going to have a stock price.
Oh yeah, that's public information.
So
If you figure it out on your own, but you're using public information, that's perfectly fine. Yeah, you can.
What about politicians?
Well, the Congress can trade on insider information, which irritates a lot of people. So if they're interviewing someone from the Fed, they can tell the Fed's going to do something unusual tomorrow. They can go trade today, and that's legal. Now they passed some laws to try to bring that down, and those laws have been so watered down. So I know Pelosi has gotten a lot of flack for what her husband's been doing. It's been legal for them to trade, which seems really crazy. Their argument is, if you look at trades congressmen and congresswomen make, they're really horrible investors. So if they are trading inside information, they're not too bright. So you can't argue that they really, except for people like Pelosi, who either she's using information or her husband just are really, the two of them are really good investors. Who knows? You would think you could do really well if the Fed tells you something and it's not public. That would give you a huge advantage. But so far they really haven't done much with it. I'm hoping this clock is correct here. Yeah, good. So The Economist had an article just this week. This huge move to passive investing, people just buying indices. What's that going to do to the markets? And there's been more and more debates on that. And one of the questions here recently is this move to passive investing. Is that the reason the stock market's so high? If people aren't doing that fundamental analysis and saying, wow, NVIDIA is overpriced, AMD is overpriced, everybody's just buying the market and that's causing the market to go up higher, is passive investing causing these bubbles? And there's something called allocative efficiency, which is one of the goals of the stock market is to decide on winners and losers. We want to put Bed Bath & Beyond out of business. We don't put JCPenney out of business. We don't put Sears out of business. Those are bad companies. Let's put them under. We want NVIDIA to do great. That's a great company. So you want these active investors deciding who the good companies are, who the bad companies are. They're helping us allocate our capital in the economy much more efficiently. And if everyone's passive, everybody's just buying the market, who's going to do that job for them? So who knows? That's an argument that isn't quite there yet because passive investing is probably only about 35% of investing. There's still a lot of active investors out there. BlackRock has gotten in some trouble. They're a big passive investor. They're the biggest passive investor along with Vanguard out there. And so what they've done is they have active and passive investors, and what the active investors have said, hey, you passive investors with all your shares, let us vote your shares. You don't want to do it because you don't have time to mess with it, but you got 1 million shares, let us vote your shares for you. And that gives BlackRock a lot of influence. And now what are people saying? Texas is saying, we hate BlackRock because they're pushing all this climate change stuff on us. You have people in other states like California saying, hey, BlackRock, we hate you because you're not pushing climate change hard enough. And poor BlackRock is caught in between. Are we supposed to be activists or we're not supposed to be activists? But that's one of the arguments they make is we're going to still be active investors. We're just going to take our passive shares and we're going to vote them by our active managers, which gives Vanguard and BlackRock what? Tremendous power over our economy and over our stock market. Is that what you want? You want BlackRock having that much power? They can kind of, between BlackRock and Vanguard, they can essentially hire all the boards of all the companies in the United States because they own so many shares. So who knows? Buffett says active investing can work because he says investing is like batting when they don't call strikes. Can you imagine Major League Baseball and they never called a strike? The games would last a long time, wouldn't they? You just say, just stand up there until the pitcher wears out, and then we'll start hitting them out of the park. I agree with them. There is some of that if you're patient enough. The problem is when I was an investor at USAA, is I discovered that we're paid to swing. So it's true, you could be patient, but if you're being paid to swing, what are you going to do? You're going to swing all the time. That's what my boss every day, what are you doing today, Ron? What are you doing today? It's like, same thing I was doing yesterday. Oh, you should be making trades. Like, why would I make trades? But he thought like every day we're figuring everything's out. But so we're forced to make swings. If you are a long-term patient investor, you can do well. So where would you want to invest if you have that kind of investor? It's not going to be a mutual fund. You're going to do a family office. That's the best place to be. Yeah, that's not it. You want a family office that's investing. So what is a family office? That's a portfolio firm that invests the money of some wealthy family. They have one big investor, maybe the HEB family, maybe whoever, these big corporations have billions of dollars to invest. And they only have one client. That client's like, do whatever you want to do. You have plenty of time. I don't care what the market's doing every single day, just invest for the long term. There's some podcasts where they interview some family office investors, and it just sounds like the perfect job to me. You don't have this daily stress. Oh, the market's down 1%. How did you do? It's like, why do I care? 1%. It's nothing. Who cares? That was my boss every day. The market's down 1%. What are you doing? Market's down 1%. What are you doing? He thought my IQ went from 140 to 70 every other day because I was trading or not trading, whatever. It's like no one has that figured out. With family offices, you can just take your time and say, hey, we got this trade. It's not working. It hasn't been working, but this is a really good trade. Its day is going to come. We're going to patiently wait for it. Total assets, the top 100. The Walton family, obviously, that would be a fun family office. $224 billion. Bezos. You reckon there's any of the other ones here? There was one that I heard a podcast about that was really, really interesting. It was the one of these buffet firms, but I can never remember the name of it. It's one of these steak buffet firms, and family made $1 billion and they started a family office. Just sound like a really, really good place to invest. So a lot of names you probably haven't heard of, but a lot of money and usually shielded from the markets. You usually have a much longer horizon, so you can play out your bets without that daily battle. All right. A few things we'll cover real quickly. that you can do if you do it yourself. You can be your own investor. You can short securities. So by shorting security, you sell a security that you don't own. So let's say you think NVIDIA is just overpriced. It's going way too far. You could sell NVIDIA. And if its stock price falls, you buy it back for a lower price and you make money that way. What happens if NVIDIA goes up though? You lose money. How much could you lose if you shorted NVIDIA? Infinity. So what do you do with an infinity trade? You don't do it. So if I shorted NVIDIA stock, I would probably buy call options out of the money to half my loss. So if you short a stock at 100, hoping it's going to fall to 80, you might buy a call option at 120. So if it goes to 120, that's the most you can lose. We'll talk about call options later. I don't like unlimited losses. It's just, to me, really uncomfortable. Think about that if you had shorted, think about the people who shorted GameStop, right? It went from 20 something dollars to $400. If you had shorted that, you would have lost a lot of money. It would have been pretty painful. But you can, huh? Well, your broker is going to have a cash call. And if you don't have enough cash, they're just going to close out your position, whatever losses you have. So the broker's really worried. I don't know if any brokers lost money with the GameStop trade, but yeah, that was a really dangerous one because those shorted securities were losing a bundle. You have to put up collateral for your short securities just in case it does move. So yeah, your broker's going to watch that carefully. And they'll call you. I've had broker calls where they say, hey, if you don't do something, we're closing down your position. You're like, oh man, I better move right now. I had to do one option trade while I was riding my bike in Iowa. I'm on my phone riding and doing an option trade because unfortunately something happened while I was on my trip. So when you hold a security short, you can have infinite losses. You're essentially borrowing someone else's security and selling it. That investor doesn't know you borrowed their security. Only your broker knows that. But if that person wants to sell it, you're going to have to bring it back and give it to them. And your broker had to go find that security somewhere else. I've shorted some securities where the broker calls and says, hey, they want their security back. And you have no option. You have to send it back. So you're a little bit out of control. Some securities is pretty straightforward because there's a lot of liquidity. There's a lot of volume. So you probably have no trouble, nothing to worry about. So you borrow it and you have to set up collateral. And then as the stock price moves, your collateral is going to change. This is a securities lending industry that really supports this industry. What securities lending does is they're the ones that lend out all these securities, everybody else asking for the collateral. You can make money off of securities lending. Most mutual funds do it. So at USAA, we loaned all of our securities. People want to short securities, like, yeah, you can short ours. That's fine. Pay us a fee. We'll make money off of it. We got letters from angry investors in 2008 saying that shorting securities was driving the stock market down and we should refuse to do it, but we couldn't refuse to do it because we would have hurt our investors. So we kept shorting security, allowing people to borrow our securities. So the people who are actually lending out their securities, they can make money by allowing their securities to be loaned out. And they make money. You can look up securities lending. It's a massive industry that hardly anyone's heard of. Al Gore was on the board of one of these companies. I don't know if Al Gore knows anything about securities lending, but I think they just were purchasing his name, put it on their board. It's a massive industry, but very concentrated and kind of behind the scenes. But they're the ones that make securities lending, short selling work. Because you got to get the security from somebody. And so Vanguard, BlackRock, all these big mutual funds, they lend out their securities all the time. It's just a way to make a few extra basis points on your return. I'm not going to go into the math, but you can kind of figure it out. It's a dangerous thing. If the stock price falls, you make a lot of money. If it rises, you lose money. At USAA, we used to have portfolio managers. We had to do what was called Y cords. So we went down to the cells, the phone banks. We had to listen in on phone calls. I remember this one lady was on the phone and the sales rep said, hey, you have a security shorted. And the lady's like, oh, I forgot about that. And I just passed out. It's like, you shorted security, you forgot about it. It seems crazy to me. I was like, oh yeah, I forgot all about that. When I short securities, I like to do paired trades. I like to try and find two securities that generally move together, but they've separated. What I want to do is short the expensive one and buy the cheap one. So when they come back together, the one I'm long on goes up and the one I'm short on comes down. We've done some of those trades in Investment Society. They're really good trades. You should look up paired trades. You see how that works. We did it once with Walgreens and CVS. So Walgreens was down, CVS was up. And the reason for that didn't make sense of us. So we shorted CVS, we bought Walgreens, and we didn't really care if they went up or down. We just wanted them closer together. So they both could have gone up, but Walgreens went up more, or they both could go down, but CVS went down more. And we made quite a bit of money on that trade as they came back together. So it's an interesting way to trade. It allows you to bet not just on the stocks you think are good, but you can also bet on the stocks you think are bad. So you can bet on both sides. So it's pretty interesting. This became really popular where we started to have these long short portfolios. A lot of them are like 130-30 funds where they're long 130% and short 30%. And I don't want to get into details of why that was so popular, but it's essentially they were saying it just allows us to diversify the portfolio a lot better. Yeah, I'd love to talk about that more. If we have more time next class, I might talk through it. But then market neutral, we did a lot of market neutral at USAA. That's when you're 100% long and 100% short. Essentially, you have nothing invested. So you have $1 million buying stocks and you short stocks $1 million. You have zero cash invested and you're just hoping you bought the good stocks and you shorted the bad stocks. That's called market neutral. Anybody know why they call it market neutral? You want to have a beta of 0, which means what? You're completely uncorrelated with the market. You make money whether the market's going up or down. You lose money whether the market's going up or down. You're completely uncorrelated. So it's, in fact, if you believe in active investing, that's probably what you should be doing. You should be picking the bad stocks and shorting them, picking the good stocks and buying them. And you have no money invested in them. All you got to do is just make, what's your return? If you make $1 million, you invested 0. What's your return? So you take $1 million gain, divide it by your investment as 0, and your return is what? Infinity. Does that sound like a good return? How many of y'all made infinity last year? Not very often, right? So that's like the best trade. What's your return if you lose $1 million? Infinity as well. So yeah, I mean, either way, you make infinity. So that's really good. But that's market neutral. Market neutral is a hedge fund strategy, a really popular hedge fund strategy that you see quite a bit. Buying stocks on margin. I don't want to spend much time on that, but essentially you borrow money from your broker. So you want to buy $100,000 of stock. You use $50,000 of your broker's money, $50,000 of your money. So you essentially leverage up your return. So instead of making 10%, you make 20%. That's buying on margin. You can look at the numbers there. Margin trading is essentially the only way brokers are making money today. So they don't have commissions anymore. So this is how they make money on the margin accounts. They're essentially banks making a spread. All right, so I want to get into expenses for investing. And then we're going to very quickly be getting into measuring return and measuring risk. All right. Are we doing a team case this week? Can't remember. What did I say? I think we're going to do a tactical on Wednesday. Is that something right?
So we're going to go over practice question 2.
Yeah, the tactical question. We'll do it this week and then we'll do it before the exam as well. So has any team volunteered for me to grade their team question on Wednesday? Do we have any bold, confident teams? Y'all think about it. I want to grade one team in class. If not, I'll write the answer and I'll grade mine, but I think I'll make 100 because I'm writing the question. So I have kind of an advantage. All right, we'll stop there. I don't want to start anything new. All right, everybody listen up. If I were you, the first thing I would do is capture the key points. So let's start off with the economy. Was this strong or weak? Weak economy. Rates, are they rising or falling? Falling. Rates, are they stable or volatile? US dollar, rising or falling? Inflation, high or low? Low. Europe, Now here, we're not gonna say strong or weak, we're gonna say stronger or weaker. What was Europe or developed? Stronger. And then emerging, stronger or weaker? Weaker. All right, so if you've got that, you got 90% of what you need. Because that's gonna tell you whether you want high quality bonds, whether you want more duration, whether you want to avoid mortgage backs, do you need tips? And that's gonna give you the most of what you need. So I would start with that. You might even just write that off to the side, right? Did I leave anything out? Is there any factor that we don't have? We got the tax rate, right? So that you just have to calculate. But you essentially have everything you need in that one list. All right. So let's look at theirs. So they have two things on the long treasuries that make sense. They say overweight, economy is falling, interest rates are falling, meaning bonds will go up. So how many, I don't know if I can copy this into Word. We'll try.
Is there a reason why we chose zero bias? Like another situation, another market.
Well, Europe dominates and developed. They're probably 70–80% of it. Yeah, Japan's it. Well, probably not. Japan's in there. If I don't give you Japan, then you just have to assume Japan's neutral or something. Obviously, Japan's been the strong performer.
Professor,
Uh-huh.
I sent the doc, so it looks nicer than,
Well, I'll do it here since I've got it, so I can put it all in one document. All right, so they said, so you should have two bullets here, right? So let's see how they did that. Overweight, economy is falling. So they need a few extra words here. So the economy is falling. So what do you want if the economy is falling? You want high quality bonds or low quality bonds? High quality. So you want quality. I'm going to add some words to y'all's answer. And they say interest rates are falling, meaning bond prices will go up. So I'll give them that one. So I'm going to give them 1.5 on the first two. All right, and then we've got inflation index treasuries. Here, how many bullets here? Should be two. I don't know why Bill Gates wanted to give me that. How many did you say? One, yeah, I thought someone said two, but yeah. Underweight due to falling inflation. So that's fine. Yeah, and Bill Gates. Mortgage-backed securities, how many things under there? Just one. Underweight due to volatile rates. Convexity here, you could say you want to buy convexity if you want to add that in there. Now, so I'll give them the full point here. I'll give them a full point here. One thing I will say, if rates are stable, you do have to add an extra word. If rates are volatile, they say, hey, avoid mortgage backs, expecting volatile interest rates. But if rates are stable, you have to say overweight mortgage backs because of stable interest rates, because you want the higher yield. You have to talk about that higher yield. So that a little extra there. All right. Then we've got munis and corporates. So there's several things here. First, they're high quality. Is that good or bad here? Good. That's a good thing. They're long term. Is that good? That's good. So you got two positives going. So let's see what they say here. How many bullets here? This is one where people lose a lot. Three bullets. Yeah, overweight. So they're talking about the municipals. They should have done some math problem here. Let's see if they did that. So they're overweighting. They're not, boy, I'm having a little trouble figuring out your answer here. I don't know if it's better in. All right, so
You're having trouble with the candidate because that's something when he on his email, he sends you where it's more clear which one.
yeah, but I don't, yeah, I don't know if I can open it. If I can open it and copy it again, that might work.
Oh, it's the he sent it like at the top. There.
Let's see if it let me do that. All right, it's gonna get messy. On treasuries, short-term inflation, we already got that, mortgage backs. All right, so this is an important one because it's 3 out of the 18, so it's a huge part. You know, it's 15% or whatever degrade, so it's a huge part of it. So they're high quality and are long-term, and you can combine them with the corporates. So it's high quality corporates, high quality municipals, it's long-term municipals, long-term corporates, and then you have to compare the two. So here, excuse me, I don't know why Bill Gates does that. No value whatsoever. So overweight, but they should have done the math. So what was the math? Anybody have the math?
It was 5%.
So what were the municipals yielding? 375, and what was the tax rate? 25. So 375 divided by what? Anybody get that number? Right, so that you need to do that. You know, so in something like that, I'm not gonna give them much credit without that math. Maybe I'll give them a small fraction because they at least mentioned that taxes is important, so that's good. All right, so that's the first bullet. The second bullet, they say overweight. Oh, come on, Bill Gates, my word. Overweight due to the spread on corporate. So why would that be good if you're buying corporates and munis? Why would you want it? The municipal spreads are gonna be widening as well. So you want to overweight. Why? This one's a little tough, but high quality and weak economy, lower quality bonds, spreads, widening. I agree you want to overweight them because they're high quality, but but the spreads are widening. It just means high quality spreads aren't going to widen all that much. So this one's a little bit more involved. Scroll down.
Can you talk about what you just,
All right, so they said in here, this is a really important comment up here. They said corporate spreads are going to gap out.
Right.
All right, so that includes high quality AAA, but they're not going to gap out much if you AAA. All right. But if you triple B, boy, you don't want to buy those bonds.
Right.
Their spreads are going to really gap out the most. So then the question might be, and this is where the nuance, do you want treasuries or do you want high quality corporates? They don't give you enough information, but you can make an argument for either one.
what is gap out?
Just go wider. What word do we use? Narrow or widen? They're going to widen. Gap out means increase. Yeah. Well, widen means the spread was 100 basis points, now it's 200 basis points. So that means the spread's widened. That means the interest rate goes up, so the price is going to come down. All right, so the risk-free rate's going to fall, but spreads are going to widen. Treasuries don't have a spread, so they just have rates falling, so they're gonna do really well. Corporates, you're gonna have the risk-free rate falling, but the spread widening. For high quality, you're gonna get much more impact by the interest rate, the risk-free rate falling than the spreads widening, because spreads won't widen much. But triple B, yeah, you can get the benefit of the risk-free rate falling, but the spreads are gonna gap out a lot. And so they're gonna fall in price. So the main thing you want here is you like the high quality because of the weak economy. You don't have to get all those words in. You can get full credit by just saying, I like the high quality because we're in a weak economy. That's really what I'm looking for. I added a few extra words in there, so. And then what's the last thing they didn't talk about? We said it's high quality, long-term munis versus corporates. What's the one they didn't talk about? Yeah, overweight, long-term as rates. Oh,
No, I think
It's what under.
that's right, that's that one,
I don't see it.
it's that one right there, because then it goes into the next point, high yield.
I don't see you talking about interest rates here.
We just put like overweight amount, or maybe not the interest rates.
Well, yeah, so you can't just say overweight long-term. You have to tell me why.
Okay.
All right, so here I might give you might give you 1 out of 3 here. So this one's the tricky one. This is when people really lose a lot of points. All right, so here 1 point on high yield. That one's good. That one's pretty simple. I do get students on high yield talking about interest rates. You don't talk about interest rates on high yield. No.
Can you type out what's like the overweight long term where you would want to hear?
That's what you need. They're high quality, so overweight because they're high quality. They're long term, so overweight because rates are falling. And between munis and corporates, here I should have written out much more. Overweight munis as 5% is greater than what? What were the corporate rates? 5. Oh no, you don't. Excuse me. Underweight munis as 5% is less than 5.1%. Okay, so there's 3 things there. This is where students probably lose their most points, that and the stocks. They just make it really clear. Talk about interest rates rising or falling. Talk about weak or strong economy, and then do the interest rate calculation for the taxes. All right, so that one's good. Then we got stocks. How many things should be on the large cap growth stocks?
3.
Well, you'll have 2 out of 3, right? So you got whether they're large cap or small cap. So, and what's the first 2 words you're gonna say? Within stocks, overweight large cap. So here you want to say overweight large versus small given weak economy. So there's 1. And then you have to say overweight growth versus value given weak economy. Now they say defensive. You can't use the word defensive for growth. Defensive is defensive stocks, low beta. All right. You can't call growth stocks defensive stocks. Most people find that kind of strange. In fact, most people think growth stocks is a little bit more high flying than that. So don't throw the word defensive in unless I tell you it's defensive or low beta stocks. All right. All right. So I'll give you 1 here. Now, if you said, well, okay, I'll give you 1.5. It's a little confusing. So they say growth stocks high quality. I kind of give them that. So that's certainly true. Growth stocks are high quality. You got a weak economy. So I kind of give you that. Now here, if you had said within stocks overweight large cap versus small cap given weak economy, you get your point for the small cap. Because you mentioned small cap when you talk about large cap, so you don't have to say it twice. All right, here, so how many points do you think they're gonna get here? So 1 point out of how many? So why do we not like small cap? High beta. Is because they're small cap or is because they're high beta? And it's both. All right. You got to say it twice. So you should say underweight small cap in weak economy, underweight high beta in weak economy. You got to say them both. All right. To get the full credit. Why did they only get one? Where they're right to underweight because it's a weak economy, but I don't know if you're saying underweight because they're small cap or underweight because they're high beta. I don't know which it is.
I think I missed it whenever you were talking about US large cap stocks, we're overweight because large cap stocks, do better than small cap stocks.
In a weak economy, large do better than small, but also growth stocks do better than value in a weak economy. Those are both true. They essentially got it, and that's why I gave them 0.5. The word defensive bothers me because that really goes with high beta, low beta. We don't use the word defensive for growth stocks. So I'm saying that more for an interview or something. You know, don't say defensive growth stocks. They're going to be kind of confused on that. So think of growth stocks as high quality. Defensive stocks are low beta. You know, it's kind of think in those terms. You can't assume large cap growth stocks are low beta stocks. All right. They're actually doing pretty well for the first time through. That's why we do this. Remember last semester, the first time through, they got like 3-4 points. And I was like, whoa, that you're actually looking for a lot. It's like, no, I'm looking for you to understand all of the stuff. You got to go on the detail. The details is where you make your keep in finance. Overweight on developed markets due to a weaker dollar. And yeah, coming out of recession, you probably want to be a little clearer there, but they got it here. So I knew they were going to do well on that. I could hear them talking. So they got both points there. They talked about the dollar, which they need to do. And they talked about Europe and Germany coming out of recession. So they got the 2 points. You want to talk about the dollar and their economies, and I won't make those contradicting. If the dollar's weak, I'm going to like developed markets. If the dollar's strong, I'm going to not like developed markets. So I'm going to make them consistent. Emerging was pretty simple, wasn't it? Underweight. You just kind of summarize what they said. China's not doing well. Other emerging aren't going to do well. So that's pretty straightforward. It always amazes me students that don't get any points in emerging markets because you just read it, right? It's pretty obvious that that's negative. All right, alternatives. There's several things here. So you got a weak dollar. What does that suggest? Gold might do well. Inflation's not high, but we've seen the weak dollar is more important than inflation. What else did they tell you? What did they say about commodity prices? Pretty weak. So what do you want to do with commodities? Underweight. And then they mentioned real estate. What about there? Might do okay, lower mortgage rates. So you got 3 things. You don't have to do all of them. Overweight real estate, especially real estate, due to lowers mortgage rates. I don't agree with this part here because what's another real asset? Commodities are a real asset. All right. So you don't want to say that, but I do agree with that one. Overweight commodities through the weakening dollar. All right, so that one's a little tricky, right? Because what did they say about commodities? Commodity prices will be weak, so that's going to be a tough one. What could they have said instead? Yeah, if they said overweight gold, the weak dollar, you could have done that. And then they could have said, this one's the easy one, underweight commodities due to weak prices or whatever. I forget what we said we're going to do there. All right, so I might give them 1.5 there because they kind of implied gold a little bit. Y'all see why some students get very few points. You really, I want y'all immersed in this. This is what it's all about. This is the application of it. All right, so let's see how they did. 3, 4, 7, 8, 9, 10, 11, 12 and a half. Almost 70%. That's actually really very good for the first strike. So it doesn't sound good. How would you do if we did this whole thing over again today? How would you do? You would have nailed it, right? So it's just practice. So we'll do this again after the break for the exam. But questions on this? Are y'all seeing how this works?
So you want to combine the answers for municipal and corporate,
Yeah. Municipals and corporates. And municipal corporates, they're exactly the same on quality. They're going to be exactly the same on duration. So there's no reason to talk about municipals and then corporates separately. Just put them together because the first 2 points are the same and the last one's the only difference.
So
Just a second, right? Shh, I can hear.
if you were to take drawing, how would you underweight or overweight large cap versus small cap?
Yeah, strong economy, you prefer small cap.
Okay,
Strong economy, you like cyclical stocks. Strong economy, you like value stocks.
I roll back to the very top when you was typing in. Yeah, right. That's what I gave you.
Yeah, so weak economy, you're gonna want you want treasuries and high quality corporates. You're gonna want, oh, they left out something really major here. What did they leave out? Stocks versus bonds, right? So underweight stocks and move to long-term, high-quality bonds with weak economy. All right, so they didn't get that one at all. So don't forget that one. It's not on the list, right? So that one's a pretty important one. I'm sorry, what?
Like I said, you said, like, for the recommendation for welfare, math class hello. Are we supposed to answer this off with on?
I would just start with that one. Just write it down. Why don't I put that on the list? Because that's just the thing you always go to. It's like the first thing you should talk about. It's like a given that it's always there. Yeah, you always talk about it. In fact, if you got into an interview question about this, that would be the first thing you talk about. All right, we're going to underweight stocks. I would start with that, and then you get into details. Within bonds, I'm going to do all this stuff. Within stocks, I'm going to do this kind of stuff.
When you talk about the large cap and small and mid cap, what's, I know we have to talk about style, like what's like the style that you talk about?
All right, so if you have a weak economy, you're going to say within stocks, large cap over small cap and mid cap. Why am I saying within stocks? Because you might actually underweight large cap, but relative to small cap or mid cap, you're going to have more there than this. So within stocks,
yeah,
growth over value. Within stocks, what's the last one? Yeah, defensive and low beta over cyclical high beta. So now, if it's a strong economy, you don't need within stocks. You're just gonna be overweighted.
Yeah.
All right.
You can explain that time in the big stuff.
Well, let's say you normally have large cap 40% and small cap 15%. Your stocks add up to 55%. But you're expecting a recession, so you might take them down to say 38%, and you may take them down to 5%. You've reduced them both. But if you looked at the percentage, you went from 40-15 to 38-5. What did you do with large cap within stocks? Large cap is a much bigger percentage of stocks overall, but stocks overall are a smaller percentage. So essentially, I'm saying 40 divided by 15 is not as large as 38 divided by 43. So that's what I mean by within stocks. So you may actually have less than large cap overall, but relative to small cap, they're not going to be nearly as small.
Okay, in this situation, where you were, like, what we can concentrate on what's up to say. Create, more, like, if you're saying the small caps would be higher.
Right. And there I'll just say overweight. Yeah, overweight small cap. I don't have to say within stocks. If you're overweighting, you're just overweighting those stocks.
Okay, so with this stock, within.
Yeah, you don't really only have to say that if it's a weak economy. Yeah. Right. So if the economy is weak, yeah, stocks, large cap over small, all the way down.
Should you talk again about the mortgage-backed securities? I would think that because those forecasts that really did really well.
Yeah, mortgage backs have nothing to do with real estate. All right. When people buy mortgage backs, the quality is essentially taken care of by the security itself. So it's Fannie Mae, Freddie Mac. Most mortgage-backed security holders, unless they're in some really, really dangerous tranche, they don't worry about the quality of real estate. They're worried about prepayments. All right. So it's an unusual. Most mortgage-backed securities are AAA rated, high quality. You're not worried about the real estate market. You're so protected there. All right. So it really is interest rate only. Now, if you're doing some subprime event, we're not talking about that kind of mortgage back. These are the high quality kind of. If you need to think Ginnie Mae are full faith and credit protected by the government. If the real estate market goes under, the U.S. taxpayer is going to bail you out. You don't have to worry about it. So it's entirely interest rates. Other questions?
Can you just go down to alternatives?
So alternatives is the one that's not obvious. It just kind of depends on what I give you. But so if they say commodities I can do well, don't talk about real assets. You may have to break them up. In this case, you could get really sophisticated and say gold will probably do well with a weak dollar. However, inflation is not an issue, so it may not do as well as you might expect. There's a lot of things you can add.
Does it mean like large cap and growth go hand in hand with small cap? And value goes hand in hand with that growth?
Well, yeah, large cap is higher quality generally. Growth is higher quality generally. So yeah,
You're saying the same thing. You say overweight large cap. It's the same.
Well, there are small cap growth stocks.
Okay.
I'm not going to give that to you because small cap won't do well, but the small cap growth might do okay. Now, small cap growth are much higher quality than small cap. So I don't do that. I don't mix them up. I'm not going to give you large cap high beta because one of those is going to do badly, one's going to do well. So it's Jay.
Yeah. I wonder if you can explain the line where you say assume our marginal tax rate is 25%, etc. Can you explain what am I doing?
You only do that in one place. And that's to take the 3.75% on municipals and you divide by 1 minus the marginal tax rate. And then you compare it to the 5.10. So 375 divided by 1 minus 0.25. Y'all told me that was 5%. Hopefully that's the right number. 5% is less than 5.10. So we prefer corporates. We want to overweight corporates, underweight municipals in this case. Yeah, the only difference on those two, they're both high quality, they're both long term. So the only difference is the tax adjusted yield. The municipal's tax adjusted yield is 5%. The corporates, you don't do any adjustment. It's just a 5.1.
So at the Fed meeting today, they didn't cut anything, but they said that it's projected to be cut. So like right now, we're going to cut it. Would you hold on to long term forward?
Well, it's a forecast, right? So the bond market's already forecast that. So you're not. You're trying to figure out what do you believe that's not priced into the market. So it all depends on what you think is priced into the market. All right. So if the Fed says something unusual, that's when you might have some opportunity. This forecast looks pretty bad. It's pretty good on China. They got that right. You might say, well, interest rates didn't fall to 3.5%, but look at this treasury yield. Where's the 10-year treasury today? Like at 4.1. That overweight long-term treasuries would have done really, really well because interest rate, now they fell much lower to like 3.8 and they've come back, but still 4.8 to 4.2, that would have still done pretty well. Avoiding large cap, underweighting large cap. I mean, well, you would have overweighted large cap growth. That actually would have done really well. So actually this forecast isn't that great because no one's expecting a hard landing anymore, but the actual allocation came up would have, by just pure luck, would have done pretty well. I don't think overweighting developed would have done well. Avoiding emerging actually would have done pretty well. Why did develop do a lot better? It's not doing well, right? Develop's not doing well, but why is it doing somewhat better? Because of Japan. So Japan's helping you out, but then the yen is weakening, so that's offsetting. So, you know, there's so many moving parts. So this is not the definitive answer. When you get into it, well, you can have like 20 things up there that you got to somehow figure out the balance. So it's not easy. I'm trying to get you so you just get used to all the pieces you got to think about. That's why we love it so much. It's complicated. The average person on the street can't. That's what we talk about, spatial intelligence. You do this so much that your brain can see all of those factors at once, and you can start putting them together. Where do you get there? You know, it takes 2 or 3, 4 years in the job every day, 50 hours a week. You just suddenly become just natural for you. So yeah, there's so much more in all of this than that we could do. Any other questions? I mean, we took quite a bit of time, but this is pretty important stuff.
Could you maybe post like an example or two of those just to practice over the break?
Well, there's some in the notes. Yeah. I tell you what, I'll look and see. I'll find the ones I did from previous semesters and tell you where they are, where I did exactly this. Because we wouldn't have done this in a previous semester because this was the previous semester's exam. So I'll find those and tell you what class to go to. Well, I'll say this up there, but I don't know if I have the actual answers. I'll leave this up at the top. I'm going to unhighlight this. So what's unhighlighted is the actual question, and then down here, what's highlighted is what I added to their answer. So it's not perfect. Don't leave yet. We still got a few minutes. Yeah, I'll put it out there. Other questions?
So based on the yield, and only the yield, if it should be overweight or under.
Yeah, you don't have to worry so much about the yield other than on the municipals. I mean, if you wanted to, I mean, there's no question here. The mortgage backs are paying a pretty good spread there, 60 basis points. I say on average, it's like, 25 to 40, but I don't want y'all, because you don't really have that history, right? You can't off the top of your head say, wow, 540 versus 480. I'm not looking for you to do that. Only place you have to really worry about yield is municipals versus the corporates, where you adjust that one number. All right.
You have to simply talk about which one you have to overweight and then talk about the one you have to underweight. Like comparing.
Well, you just say between municipals and corporates, I want to underweight municipals. You just have to have that one bullet. So you have 3 bullets on the municipals and corporates. One of them is going to be. So do you like the high yield? I mean, the high quality. Do you like the long term? Yes, yes. Okay. What about municipals versus corporates? Well, there I'd rather have the corporates than the higher yield. All right. Any other questions? All right. So let's finish up expenses. We have 10 minutes. We can finish here. So expenses, it depends on whether you're a small retail investor or if you're a massive institutional investor. If you're a small retail investor, your expenses used to be commissions. If you're trading, pay commissions. Commissions have essentially disappeared to zero. So I don't know if I told you my Frost Bank story. Did I tell you all that? So yeah, I mean, it's just, there are some brokers that are still charging $40 a trade. It's just insane. And the reason they're doing that is that they don't want to do the brokerage business. USA got rid of its, it sold it to Schwab, which I'm kind of glad they did because I really love Schwab. Schwab lets me do anything now. It's amazing. They love me as a customer. If you give them a lot of money, they tend to like you. And so, yeah, it's been a great firm. I need to email them because they helped me set up 2 accounts and they were so efficient in that whole process. So yeah, I need to remind to email the woman that helped us. Really good. So not all brokerages are the same, especially today. There's 3 or 4 that are just the obvious ones because they're so low. So this one's almost disappeared. Where you're going to get killed is on what's called the bid-ask spread. So the ask is what you have to pay when you buy, the bid is what you get. And that difference is much bigger for retail investors. So at USA, when I did trades, I never had to pay the bid. I mean, the ask, I never got the bid. I got something in between, always. Much better execution. But as a retail investor, yeah, I'm going to pay the higher price and receive the lower price. And you can see that in trades. You can see that in trades where, you know, the bid is $8.90 and the ask is $8.87. There's $3 difference there. That $3 difference, that's your cost of trading. It's pretty expensive. You know, if you buy 10,000 shares, that's 30,000 bucks. It's going to cost you just to do your trade. That's the bid ask. Who's making that money? Well, that's how the market gets paid, for providing that liquidity. So the bid ask, just it's the difference. If the bid ask is really wide, that's probably a very illiquid stock, and you're really getting crushed on the trade. So you don't want to change your mind. If you got to hit a wide bid ask spread, if you buy the stock today and sell it tomorrow, you're going to lose a lot of money just because of bid ask spreads. So, you know, you want to watch the bid ask spread. It's probably more important for options than on stocks, but you need to watch that. So large cap companies, very liquid companies usually have really narrow spreads. Smaller companies, not as well known, they're going to have much wider spreads. So you just got to be careful of that. That's probably your biggest cost. So I, as an institutional trader, my bid ask, I really got average in between the two. It really didn't impact me much. I saw very small difference between what I bought stuff at and what I sold them at. It was fractions of pennies. But for you as a small investor, it's going to be much wider. Where did the big investor get hit? It was a market impact cost. So when I personally buy stocks, the market doesn't care. They don't notice. Oh, wow, Ron just bought 100 shares. No one cares. But as a large investor, someone's buying $10 billion worth, their actual purchase, when they put it in, that can cause the stock price to rise. And doesn't mean they purchase it and the stock rises. That means their purchase causes the price to rise, which means their purchase means they have to pay more. Why that? Because of the supply and demand. You have a big trade, there's not enough people selling, the price is going to shoot up. So that's called the market impact cost. Can be both ways, when you're buying and when you're selling. So that was so you as a retail investor don't have to worry about that. It's unlikely you're going to have such a large trade, the market's going to go, oh my word, where are we going to get all these shares from? So I did, you know, I was a small investor relative to everybody else, but I did trades at like, you know, several $100 million bucks. Even on those, I could have a market impact. Selling $400 million, $500 million of a security can impact it. So I would use something called a transition manager. What a transition manager does is takes those really large trades and they try to hide them as much as they can so they don't impact the market. And a good example is the large index shops like Vanguard and BlackRock. They're trading a bunch of shares every day anyway. So what you can do is you can go to them. We usually use State Street as our transition manager. State Street's a big index shop. We can go, you know, State Street, we're selling 10 million shares of this stock. And they're saying, well, we normally buy 5 million on a daily basis. So I'll tell you what, we'll take that 5 million and we'll just swap our shares. So, and whatever the closing price is, we'll just do that. So there's no market impact whatsoever. You need 5 million shares. We need 5 million shares. You're selling, we're buying. We'll just swap shares. All right, that works pretty well. You may not get 100%, but you might get 50% of your trade that way. Then you have no market impact at all. Then the rest of your trade, your transition manager is going to work that out over time. depending on how much volume there is in the market.
Isn't it the same as in dark pool?
No, dark pool is something a little different. No. I don't really understand the dark pool, but I was never part of the dark pool. So yeah, that's not that. Dark pool is more people cheating after night, taking advantage of the system. So transition managers, it's a big deal. I don't like them because I could never tell they're ever adding any value because it's all statistical. They come back to you after the trade and they say, hey, if you hadn't used us, you would have been this much worse off. They don't know that. They're guessing based on history what they might have saved you, but they don't really know.
So when you were talking about market impact, right? So when the company we buy their own stock, like inflating their own price back up, and they just keep doing that.
Well, but they're the ones paying for it. So if they inflate the price up, they have to pay more. So I mean, it's still hurting them.
Well, I'm not.
I mean, it's true. They're buying the stock back in order to essentially make the earnings per share grow faster than it really is growing. But they could have, when a firm rebuys its own shares, they can have a market impact. We're going to have to end up paying more than they wanted to. They wanted to buy their stock back at 100, but because it had some big trade, it's going to be 1 or 2. So that's $2 per share there of cash that's going out the door. That's going to make the firm less valuable. Yeah, so they have the same thing. Transition managers, they're an interesting group. I've used them several times. I never enjoyed talking to them. There's one transition manager. He was pretty famous because he was on anytime the transition manager magazine went out, he was usually in there somewhere. And he could never convince me. He was like, come to us. He was at Credit Suisse. Come to us. Don't go to State Street. I said, well, you prove it to me and I'll do it. And he said, oh, I can do it. I know I can do it. And we met and he could never prove it to me. It was all this statistical. So I don't know. He was an interesting guy. He went to New York, become an actor. Didn't work out. So he went into finance. Now he runs a hedge funds in India, doing energy. So interesting guy. But he was a transition manager for quite some time. Small cap is most important because they're the least liquid. They're the ones, you have some small company that, not, $1 billion market cap. You do big trade on that, you can really move the market because there's just not enough buyers out there to do the transition. So that's when the transition manager really adds their most value. On the portfolio manager side, we've already talked about that, just portfolio management fees. That's pretty easy. You can see that on Yahoo Finance. Are they charging 60 basis points, 100 basis points? Make sure you're not paying any front end or exit loads. That never makes sense. There's no evidence those add any value. That's just throwing money away. Funds that charge a front end load don't perform any better than firms that don't, even before the front end load. So you're just throwing money away. You would never do that. So passive investing has the lowest fees, and that's why passive investing beats active so well, because they start off with a huge advantage. So we already talked about that. That one's easy. You just look it up in Yahoo Finance and you can see what the management fee is. So if you got 3 funds, you're not sure which one to use, just pick the one with the lowest management fee and the lowest turnover, and you'll be done, which that's going to be an index fund more than likely. All right, so what we're going to do after the break, right? This is the last thing before spring break. We're going to get into return and risk calculations. We're probably going to be spending a lot of time on practicing question 2 on the exam on Monday, and then we have the exam on Wednesday. But Wednesday, the exam's the first 30 minutes, and then we're going to have class afterwards. All right, so we'll get some time there. So that's what we'll start. I'll let y'all go now.